do not hesitate reaching out to us. You have, and I'm very proud to say this, not only do you have our emails as our clients, you have our cell numbers. So please call us. We are here for you. We understand the role that we play. We are the bridge of care at this point to your team members that may be seeking care, that may have questions or concerns about their plans and their health. So please do not hesitate reaching out to us. As most of you know, we have created a custom website solely focused on the situation at hand, eqcovid19.com. This is updated daily with mental health resources, employee communications. We have guides, frequently asked questions, carrier updates, which are coming at a mass pace, and of course, recorded webinars, including this one, which will be recorded and posted on that site. Speaking of recorded webinars, we have the one from our speaker from last week, from Jen of Hogan Fenton, California employment law firm here in San Jose, Silicon Valley. She did the webinar on furloughs and layoffs, the significant impacts, also on the FFCRA. We had a question and answer session, which we then transcribed into a transcript. And in addition to that, we have an opinion letter of do's and don'ts in the unfortunate situation. One of your employees diagnosed with COVID-19. There are a set of protocols that need to be followed. So please look for that opinion letter. It's on the website. We have that created for you there. We are not affiliated with this company. There is no commission or compensation to ExpertQuote. It is simply on goodwill. We are mentioning this, the telehealth dentist. At this point, all of us are well versed in telemedicine. We've all learned very quickly on how to reach our medical providers using our apps, our laptops, and our phones. We've gotten some questions on what about dental work, and I might have some questions on some procedures I may need or a situation I have. Please take a look at theteledentist.com. They have online consultations. Of course, they cannot address all the needs and services you might need, but they can definitely give you a sense of a roadmap and sort of next steps. And of course, they can definitely prescribe medication if needed. We now are at our speaker. It is a privilege for me to introduce Tom. In full disclosure, PP&Co, Petrinovich Pugh & Company, is a valued client of ExpertQuote. They are very well known in the Silicon Valley, a full service accounting firm covering all industries, the full spectrum, from medium, large, privately held companies. In the Silicon Valley, they've been a luminary in the industry and in the Silicon Valley for over 70 years. Tom is a seasoned member of the firm. He is a master of his craft. I have gotten to know him over the years and very grateful that he's doing this for our clients. In the event you need to get a hold of Tom and or need their services, you can contact their marketing director. We have her information there. And with that, I will hand this over to Tom so I don't take any more time of his presentation.
Thank you, Raj. Are we set to go, Sean? Thank you for inviting us to give a presentation today. These are troubling times, to be sure. And by the way, I appreciate Raj's mention of me being seasoned. That could be translated to be old, but I'll take it as it is, as a nice presentation. But the focus of this presentation is primarily on the tax elements of the coronavirus and the things that you need to be aware of. And I've been giving this presentation, I always preface it by saying, I truly hope that hopefully maybe in June, you're going to look back on your schedule and see that you attended a webcast about, from an accountant, strike one, about a pandemic, strike two, and taxes, strike three. That's where we are right now. And I wish all of you are safe and well, and that we can look back on this and see that we are doing our due diligence, but there are happier times ahead. The point of this presentation, as I said, is to primarily discuss the tax compliance issues with the CARES Act. And the very first thing I should note is timely, because as it says in the slide, things are changing rapidly. Boy, are they. I've been giving this presentation, and every week I have to update it. And so I want to preface everything I say by saying this is an extraordinarily fluid situation. The urgency of the crisis led to them pushing out this CARES Act fast. And when we as accountants looked through the act, being the kind of detail type people we are, we started noticing immediate issues in terms of the Act's expressed goals and how the guidelines were written by the enforcer of the Act, the SBA, which created some concern. And the ultimate, and it isn't even the ultimate, the subsequent explanations and guidelines issued by the SBA on the various elements of the Act. And so in the end, for instance, the PPP that we're going to be discussing in detail, the Payroll Protection Program was unveiled. Just before it was unveiled, the banks became very concerned that the cart was before the horse. They didn't have all the factors that they knew that they had to know before they issued it. So the point I'm making is that things are fluid, and just today, to our concern, the SBA announced on their website that they're currently unable to accept new applications for the PPP based on available appropriations funding. The translation to that is they were allocated $348 billion for this part of the CARES Act, and they're out. Those funds have been allocated. I'm going to go into that in more detail, but I wanted to just tell you that in terms of the context of what this slide says, which is things are changing rapidly. I'm going to point out things in this presentation that have just changed in the last week, and keep an eye on things that may change in the future. So with that in mind, I'm going to, by the way, I didn't know there was going to be a video on this presentation, or I would have hit the flow bee a little harder, but that's where we are. So the first part of the presentation is about federal and state updates. And the most important one that just passed is the due dates. As you know, April 15th is a big day for us as accountants, and today would normally be a day that we are relaxing after the end of tax season. Unfortunately, that's not true, but what is good news is that everything that was due on April 15th has been extended to July 15th. There's lots of little issues and nuances in the rules, but I think the thing you need to know is that if you have something that was due or payable on April 15th, it has now been extended to July 15th. Federal, and that goes for federal and state filing. Actually, the state was actually ahead of the feds in extending these dates. Taxpayers can also defer federal and California income tax payments due on April 15th. That's the payment element, without penalties or interest. Important to note that the Q1 vouchers for 2020 were also extended to July 15th. And then as a new update, as preparers, our letters on our tax returns started to create some confusion to our clients. The letter would say your Q1 voucher for 2020, if you were paying estimated tax payments, is now due on July 15th. And then your Q2 payment is due on June 15th. So clearly we don't know what we're doing because we're having payments sequencing out of order. So this week, they extended the June payment to July 15th as well. So now it's not just the April, but any payments due between April 15th and July 15th, this is new, have been extended to be due and payable on July 15th. Like everything in this presentation, keep an eye on these dates. They may extend it again, who knows, but that's where we are right now. And as I note in the bullet point, estimated tax payments due April 15th and June 15th are now automatically extended. Who does it apply to? Individuals, trusts, estates, corporations, non-corporate filers, as well as those who file self-employment tax. All of those people who had something due on April 15th, or now anything between due April 15th to July 15th, have been extended. If you had something due on March 15th, that was not extended, of course. That was already due by the time the CARES Act was issued. So keep track of those dates. The IRS has announced that they will temporarily accept scan signatures, digital signatures. And then one that's amusing to accountants, the IRS temporarily is allowing workers to send and receive documents by email. If there are any accountants listening to this presentation, you are nodding with me in wonderment at that, because the level of technology of the IRS is pretty much, well, it's Pony Express level of technology. So we'll see how that goes. Some other filing dates have also been extended. The sales tax, the 2020 Q1 sales tax form is now not due until July 31st. That extension is automatic unless you have a tax liability of $1 million or more. There's a 12-month interest-free payment plan available if you owe less than $50,000. So property tax was due last week. Property tax payments in Santa Clara County were still due on April 10th. They could not extend the deadline, but may waive the penalty and interest. San Mateo and San Francisco counties did ultimately extend the payment due date to May 4th. So we have some varying due dates on property tax. The economic impact payments. So those are the rebates. Those are the refunds. Those are those checks that everybody's been waiting for. It's really in advance. And first, in terms of the timing, we're told that some of those checks are being deposited right now into people's accounts. And when you get it will depend on how you filed your tax returns in the prior years. If you filed in 2019 or 2018 and use an automatic deposit or withdrawal method with the filing with your electronic filing, you would have given them your routing and bank account numbers. And if you did that, supposedly those deposits are already being automatically transferred. If you didn't play in that form, it will be later. They're going to use your 2019 and 2018 return to tell if you actually qualified for the advance. And the qualifications are based on your income level. Just to cut to the chase, if your income is if you're a married taxpayer and your income is under $150,000, you get this advance. It's $2,400. If you're single, it's $1,200. If your income is over $198,000, you do not get the advance. If it's between $150,000 and $198,000, it's phased out. As I said, it's an advance. It's actually a 2020 calculation. So on your 2020 return, you will calculate what your credit was that you were eligible for based on your income in 2020. But you may have already gotten it based on your 2019 information that they used. So if you took the credit and you actually in the end didn't qualify for it, you do not have to pay it back. If you did not qualify for the full credit using the 2019 numbers, but in fact, when you do the 2020 return with the way the economy is and your income is less, you will get the rest of the credit with that tax return. So the key is whether or not you filed with your routing and bank numbers on your tax return, in which case they have promised to make that deposit quickly, and I'm hearing that that is happening. What is more dubious is when you will get the check if you are somebody that just filed your information with the 2019 return without that information. It could be longer for those people. If you did not file a 2019 or 2018 tax return, they can use your Social Security information. And they've also put on irs.gov, there's a clearly indicated area where you can input your information for your routing and bank account number to get that advance. So that's the economic impact payments. I should note as a point of almost humor, so they extended the due dates on these payments. And as my clients are telling me, so they're home now, they have more free time. They finally have time to do their tax returns by the April 15th due date. And now they get it extended. So where were they? They're saying, where were they for us in the prior years? But that's the way that goes. So before the CARES Act, earlier in this year, when we first started recognizing the impact of the coronavirus, they passed the Family First Coronavirus Response Act. Now, I know you've been given presentations. People listen to presentations here on this before. This is primarily the EPSLA and the FMLA. These are the sick leave and family leave elements of the tax law changes. So, first thing to note on these is when I'm talking to my clients and they say, wait a minute, I am in this level of distress and they're adding a tax burden to me. How could this be true? Keep in mind the intent of this is not an outlay or cost in the end for the employer. The amounts that they will pay in the form of sick leave will ultimately be refunded through their payroll taxes. The Family First Coronavirus Response Act went into effect on April 1st and has two key provisions for employers, which expire on December 31st, 2020. How does it work? To help the employer pay for the sick leave and the family leave, the employer is going to be able to claim a credit against their federal payroll taxes up to the amount paid to full and part-time workers. If the payments to employers exceed those payroll taxes, the employer will get a refund. The qualified sick and family leave wages for which a payroll credit is allowed under the FFCRA, the family leave, cannot be counted as wages when we go through the paycheck protection loan. So they've created this regime where there are going to be 3 potential credits against your payroll taxes. The 2 I've just mentioned, the sick leave and the family leave. And we're soon going to discuss the employee retention program, which also is going to be a credit that will be offset against your payroll taxes. I'm going to also explain that there was some complaints about the way it was going to be worked through the payroll system, and so they've liberalized how it's being paid. The Emergency Paid Sick Leave Act provides for up to 80 hours or $5,110 per employee maximum of paid sick leave to private and public sector employees due to specific coronavirus-related situations. So there are 6 situations or instances that they identify. You need to understand these 6 because the amount of the credit depends on whether you're in the 1 through 3 category or the 4 through 6 category. The 6 instances are: the employee is subject to state or local quarantine or isolation order related to COVID-19. That's California. The employee has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19. The employee is experiencing symptoms of COVID-19 and seeking a medical diagnosis. Those are the first 3. If you qualify under the first 3, you'll get 100% of the eligible credit. If you use the last 3, 4, 5, and 6, which relate not to the employee, but to the employee's dependent or son or eligible person, the employee is caring for an individual who is subject to isolation. The employee is caring for a son or daughter of such employee if the school or place of care of the son or daughter has been closed or is unavailable. Or the 6th amorphous category, the employee is experiencing any other substantial similar conditions. If you fall into that category, you get 2/3 of the credit. So the amount of the credit depends on whether you're in 1 through 3. As I said, the amount is for the sick leave is capped at $510 a day, $5,110 in total. And if you qualify for the dependent, those elements 4 through 6, those numbers are 2/3 of those amounts. So that's the sick leave element of the Act. There's also been an expansion of the family medical leave. It provides up to 10 weeks, capped at $10,000 total, paid leave to care for a child or children because their care facility school is closed. So the important thing to note on this is this part of the credit structure is strictly based on the status of your children, not for the employee. And if you qualify into this category, this amount is capped at $200 a day or $10,000 total. Just as an example that I have, if you have an employee who is applying for family leave and is, let's see, the pay rate is $24 an hour, 400 hours total, that's 10 weeks. Their pay rate on the family leave would therefore be $16 an hour. Remember, that's the 2/3 rate. Well, $16 an hour equates to $128 a day. That's under the $200 minimum, so you're okay there. It also equates to $6,400 over the full-time period, which is under the $10,000 limit. So in those cases, you would get the full benefit. Now, I'll mention again, that the means by which this credit is being paid is going through payroll taxes. So one of my clients who's smart immediately said, well, they said it's not going to cost me anything. That it's going to be a credit that I take on my payroll taxes. But I don't file my payroll taxes until I do my Form 941s at the end of the quarter. So I'm going to be carrying that cash flow burden during these troubling times for that period of time. So about a week and a half ago, they liberalized the approach and said that rather than having the credit be offset on your Form 941 payroll tax return, they will allow the employer to actually reduce their federal payroll tax deposit for all federal taxes, not just for the employer's share, by the amount of these 3 credits: the family leave credit, the sick leave credit, and the employee retention credit. So that means it's quicker. You'll be able to reduce your deposit by the amount of the sick leave credit you compute, or the family leave credit. Then when you do your 941, and we're going to be interested to see how these forms look, you will compute your credits, and then you will also obviously offset by the amounts you've already taken, and then if there's an excess, you will get that back. Another relief is that if you do it through your payroll deposit, and you find that these credits actually exceed the amount of your federal tax deposit, there's a new form. It's a Form 7200. You file that form, they're promising that it'll quickly be administered to and that your credit will come back quickly, but they refund that difference. So they have liberalized the effort to get those credits back to the employer quickly. So those are the family paid medical leave and sick leave elements of the tax law. That is not part of the CARES Act. That's part of the act that preceded it. Next is the EIDL. This is the disaster loan part of the relief provided for those suffering from the coronavirus. It happened before the CARES Act. And I really should preface my comments on this because I know if I just list out the criteria and the actual facts of this law and the expanded economic injury disaster loan, my clients were going to pull their hair out because there's a listed criteria and then there's the reality. And the reality is that it is taking a long time to process all these loans. So when I list out that it's going to be quick and that their whole thing is the emphasis is on speed, to my clients, there has not been speed. They've had difficulty getting through. And of course they're having difficulty going through. This is all going through the Small Business Administration. To give you a snapshot of where we are, and if you're there, the Small Business Administration has 3,300 employees. They've been bulked up because of this crisis, but not nearly enough. The Small Business Administration typically does about 50,000 loans a year. Now they're having to service these PPL loans and the economic injury disaster loans. There are 30 million small businesses that could potentially qualify for this relief. That's the situation we're in right now. That's why when the first day of this program was unveiled, there was at least an 8 to 10 hour period, it's my understanding, that the programs, that the online website was not even functioning. So, but that preamble noted, still note these are the rules for the disaster loan if you can somehow get through. You apply through it through the SBA website. It's available between January 31st, 2020 and December 31st, 2020. As I list these out, we're going to make distinctions between the economic disaster loan and the soon to be discussed PPP, the payroll protection loan. Most businesses will qualify to the new rules. They've liberalized the approval requirements, and the payments on the loans have been relaxed. They've been deferred. As a matter of fact, and something that we're becoming aware of just now as we read the rules, in terms of the disaster loan element of this, not only are the payments on the loan deferred, the first 6 months are actually basically are forgiven. You don't have to pay those first 6 months without interest accruing. That's a little known element of the disaster loan program that people should be aware of. There's also a grant element of the disaster loan. The disaster loan request is a little more data and they ask for a little more detail. They're going to ask, as they always do for small business loans, for personal financial information of the owners of the company. There's going to be a Form 413 that they're going to ask for, which is kind of the coordination of your tax returns with the IRS. There's an SBA Form 5 that they're going to ask for. So there's more information to fill out. But when you fill it out, there's a form that also is just my understanding is a very quick question. Do you want to request a one-time grant of $10,000? You hit that, the obvious answer to that is yes. And you might get that grant of $10,000 even if you do not get or qualify for the small business loan. In the last week, as I said, things keep getting clarified. There has been a rumor, because I haven't actually seen it on the Small Business Administration's website, that $10,000 advance will be limited to $1,000 per employee of the applying company. So if you only had 3 employees, you'd only get $3,000. That's a perfect example of how this whole law is evolving in real time. The EIDLs are obtained after January 31st, and they may be refinanced with the proceeds of the Paycheck Protection Loan. The maximum available in the PPL is increased by the amount of the EIDL, which then becomes subject to all the benefits and conditions of the PPL, and they have some more useful conditions than the EIDL. The terms for the EIDL are the loans are up to $2 million limit, a $30 million 30-year max term. The interest rates on these are 3.75% for businesses, 2.75% for nonprofits. As I said, there's an automatic 1-year deferment on repayment. So the first payment is not due for a full year. But also, the first 6 months, is my understanding, will actually not be required to be paid at all. Funds can be used to offset economic losses caused by the COVID-19 pandemic. That's a very broad term for what the disaster loan can be used for. So here's where the main distinction happens. The payroll protection loan is primarily, as it says, to protect payroll. The economic injury disaster loan is really about all forms of working capital reinforcement. So if you don't fall within the specific criteria of the PPL, you could still do the EIDL loan application and just say it's for surviving. So if you're a commercial business, a commercial residential property business, well, you don't have as much payroll, but you do have working capital needs and you have rents that have been lost, and that's where you would target the EIDL. The proceeds must be used for working capital needs such as fixed debt and payroll. The approval time is 30 to 45 days. They've promised quicker. The problem is not the approval time. The problem is just getting through. There are no fees or prepayment penalties. And the most important distinction between the EIDL, the disaster loan, and the payroll protection loan is this loan is not forgivable. This is a loan once it's in play. So that brings us to the other loan, the Paycheck Protection Program, the PPP. The loan itself is called the Paycheck Protection Loan. This is the program that has garnered the most interest. It's the most important for you if you're trying to keep your business afloat during these unbelievable difficult times. It's the one that they rolled out too fast. So as they rolled it out, the guidelines didn't match the law. When we went to enforce it, we were completely confused about definitions because they kept contradicting themselves. And in the end, it was a real mess those first couple of days of the PPLs, which is what I'm going to refer to them from here on out. They're used to provide working capital to cover primarily payroll and other operating expenses, and to refinance the EIDLs. So just imagine this scenario a week and a half ago now when these PPLs were starting to be unveiled. We, like a lot of people, called our bank, and hopefully they do small business loans. They would have a head start. And by the way, I always recommend in all of these, if you have a relationship with a bank, that puts you way ahead of the game. If they do small business loans, you're even further ahead of the game. Speed is of the essence on this, and it is a first come, first served program. So we would call our small business banker and ask for clarification on the definitions of things like payroll costs. And they were telling us, well, we're kind of looking for you. You're an accountant. You may be able to interpret it better than us. That was alarming. Well, the CEOs of these major banks, as it was about to be unveiled, suddenly realized we don't know if we're on the hook for these loans. These loans are all supposed to be about providing a fallback position for those who are in a position where they're not having revenue to pay payroll. And we need some guarantee, some reassurance that we're not going to be on the hook for the loans. You know, we always have movies and things like that about these days, and I am sure in about 2 years there's going to be a movie on Netflix about a meeting that took place the night before the unveiling of the program that had all of these CEOs of the major banks, Steve Mnuchin, the Secretary of Treasury, where they all issued their concerns. And apparently at that meeting, Mnuchin gave them a level of confidence that they felt that they could go ahead with the program. One of the reassurances apparently was that they would literally take those loans off the books for them, that they would buy them back. Remember, the whole point of this is to get money back into the bloodstream of the economy. Liquidity, it's all about liquidity. We don't have revenue coming in. We want to keep our payroll, but we can't. and speed was critical. The amount of these loans, just as an example, by the way, the B of A received 85 loan applications totaling $22 billion on day one. The amount of the loans is the lesser of $10 million or 2.5 times the average monthly payroll costs, plus any EIDL. Now I'm going to step aside here and just because we were dealing with our clients and the banks and trying to get through the minutiae of the rules. And we finally, as the banks ultimately did, said, we've got to simplify this. This is about getting money out. It's not about having to go through all this paperwork. So we really condensed the definitions. When we just said here, average monthly payroll costs, it sounds easy, but the definitions and the preliminary issuance by the Small Business Association were really complex. They wanted you to subtract retirement benefits. They wanted you to subtract FICA and other things. They wanted you to compute add backs. In the end, we were telling our clients, and I think thankfully it turned out to be right, that the ultimate way you're going to compute your average monthly payroll is simpler. You're going to take your average monthly payroll of the 2019 year. You're going to use your payroll records from 2019, ADP or whoever your payroll service provider will have that. You're going to take that number and you're going to divide it by 12. And then you're going to add to that number health insurance paid for employees during that year, because that is also a qualified payroll cost. You're going to subtract from that number the amounts that you're paid to employees over $100,000. It's limited to $100,000 per employee. And then you're also going to subtract a small amount of state unemployment insurance tax. And you're going to subtract any payments to overseas employees. You're going to get that total number. You're going to divide it by 12 for your average monthly payroll costs and multiply it times 2.5. I just articulated what you should do when you're doing this paperwork. I'm telling you, you should have other data available because there's a lot of leeway allowed to the banks in terms of how they're determining payroll costs. But it's been my experience that they too are relying on those types of annual figures from 2019 that I just articulated. So that's a simpler approach to get the average monthly payroll costs. That's the number that's going to dictate what your loan is. This is about what the loan is about. So obviously, since the loan amount is determined by payroll, it is a payroll protection loan. That's what distinguishes it from the EIDL loan, which is based on working capital needs. So if you don't have a large payroll, it's going to be difficult to qualify for this loan. Businesses can apply for both a PPL and an EIDL. That's a question that we were asked a lot. You can do both. I recommend you try both if you're applicable. The caveat is the proceeds, you cannot use the proceeds for the same purpose. So you can't use a PPL to restore your payroll and also use it for the EIDL. The EIDL has a $10,000 advance. It's excluded from the refi amounts. If a qualified EIDL loan was used for payroll costs, your PPL must be used to refi those same costs. That's how you determine the amount of the loan. What are the terms of the PPP loan? The interest rate is 1%. The loan term is 2 years. The payments for the remaining loan amounts after forgiveness will be deferred for 6 months. Interest will accrue during the 6-month period, a little different than the EIDL, the disaster loan. How must the funds for the PPL be used? Why is this important? Because if you don't use it for these appropriate functions, then you will not be eligible to have the amount of the loan forgiven. That's what's so unique about the PPL. You must use the loan proceeds for payroll costs, for mortgage interest payments, for rent, and for utilities. In calculating your payroll, the amount of salary paid to employees shall be capped at $10,000 per employee. That's that adjustment I said you have to do when you're filling out your information for your average monthly payroll. Self-employment income of a general partner may be reported as a payroll cost. This is new. So we were asked, we are a partnership. We get paid not through a W-2 and not through a 1099, but through a K-1 form that has a guaranteed payment on it. Is a guaranteed payment a qualified payroll cost? We didn't know because the original guidelines didn't address it. A lot of conservative accountants interpreted it that it wouldn't be counted. We are not a conservative accounting firm. We assumed that it would be counted. And fortunately, in the most recent law guidelines issued this week, they did say guaranteed payments will qualify up to $100,000 on the payroll cost definition. So the other key caveat is at least 75% of the proceeds must be used for the payroll costs of the company. So that's how the funds must be used. Still, many questions, still lack of clarity, particularly on the forgiveness portion of this process. And we're recommending to people, and as I'm about to tell you in terms of the status of this program, act fast, get it in quick, it's first come, first serve. So the forgiveness portion, the questions we were getting is, okay, we have to use those funds in that 8-week period following the loan in the appropriate categories in order to get it forgiven. But when does that period begin? Does it begin when the loan documents are signed? Does it begin when it's funded? Clarification was issued on that. That 8-week period called the covered period, that's where you're going to measure these costs, starts with the funding of the loan, when money hits the bank account. To verify and document that you've used those properly, you're going to have to provide the bank in 8 weeks with copies of payroll records, copies of canceled checks, rent amounts, copies of your health insurance to prove that it was properly used. But the key to this is if you can prove that, you will have the full amount of the loan forgiven. That is an incredibly important part of the payroll protection program. 2 other caveats is that you must retain your employee level. We call these FTEs, full-time employees. They're measured in numbers and fractions. So if you do not maintain your full-time employee level during the covered period, to the extent that you did not maintain it, will reduce the forgiveness of your loan. Also, if the pay of the people in that covered period goes down by more than 25%, that will also trigger a reduction of forgiveness. Now that's the loan process. That's who is eligible. Businesses with fewer than 500 employees, or those larger than that, which meet applicable size standards of their industry. Then there was this whole other category that needed clarification. How about sole proprietorships, independent contractors? They're listed in the law, but there's a lack of clarity. And as sole proprietorship, if it's just the individual, they don't have a payroll. They're taking draws. So what is the definition of payroll costs for those people? Well, this is new. In the last week, they provided a lot of clarity on that, and it's kind of self-explanatory. Again, we're going to rely on 2019 information. So if you're a self-employed person, say you have a Schedule C, a sole proprietorship, your 2019 tax return that has either been filed or will be filed will have a net profit on that Schedule C. That's going to be the key number you're going to use to do the 2.5 multiplier computation. It's limited to $100,000 per employee. So as a sole proprietor, your amount will be limited to $100,000. If you do the math, therefore, it'll be that number, $100,000. That's self-employment maximum of the self-employment amount, and the total amount of the loan at the 2.5 calculation will be limited to about $20,000. You prorate that prior year's self-employment income. You take 8/52 of that amount, makes sense, that's the covered period, of the prior year amount, multiply it times 2.5, that's the amount of loan sole proprietors qualify for. It's not as large as they would have hoped for, but at least we have some clarity on it, and that happened in the last week. So that's the sole proprietor element of this. And now let's get to real world stuff, which happened again this morning. I want to reread the current status of the payroll protection program and give you some feedback of what to expect going forward. To reread what's on the Small Business Administration's website this morning, and if this will curl your hair. The SBA is currently unable to accept new applications for the PPP based on available appropriations. That's a long way of saying we had $328 billion, it's gone, it's been allocated. Similarly, we are unable to enroll new PPP lenders at this time. Last night, the SBA was indicating they were unable to maintain a queue of PPP applications. Again, it's first come, first served. So obviously, this isn't putting enormous pressure on Congress. From the beginning, the implication was that they ran out of money. If it was not enough money, that they would replenish. But to replenish requires Congress to agree. And Congress does not agree on anything these days in a fast way. The Congress right now is in a debate about this whole issue. And the issue that they're debating is whether or not this additional amount, which is rumored to be 200 to 250 billion, will be just that alone, or they will also in this new bill include some assistance for hospitals, which God knows they need, and for states. States do not have the capacity to print money. They're going to run out of money. And so they're hoping to get support for the states now in this bill. The Republicans' point of view is you're adding too much to this. We need to act fast. And when you add something like that, it's going to take forever to get everybody to agree, because then you're going to raise the question of which hospitals, which states, priorities, who gets it first. So that's what's being debated. The interesting part of the debate apparently is that the Secretary of Treasury, Mnuchin, has been working quite well with the Democrats. And I think that's what's facilitated the first stage of the PPL to go through. And now, again, he's trying to coordinate between these factions to get something solved. I have to believe that what I just read, that paragraph from the SBA, changes everything, because now the pressure is on. The question is, if they replenish, how long will it take for this additional 200 billion to get out there into the bloodstream of the economy? We don't know. It's worrisome, to be sure, that this is happening. And we were afraid this would happen because many thought from the beginning that the 340 billion was not nearly enough. Recall what I said at the beginning. There are 30 million potentially qualified small businesses that qualified for the PPP. One of the problems as they unveiled the program is that they allowed some companies like restaurants, understandably, to add affiliates to get past that 500 employee number. So they were able to really secure larger amounts of the allocable amount. And it seems to me, again, it's the small businesses they just don't have the advocacy groups that get them that kind of prioritization that others do. And it's the small businesses that are the ones that are in most dire need of these funds. They're also the ones, that's one of the reasons for this presentation. They're the ones that have less access to information. They have less access to professionals who can walk them through that 4-page form on the PPP. I can't imagine a small business person trying to do all this on their own, trying to go through all this paperwork. And so for that person, if that person is listening to this presentation, please remember what I had said earlier about simplifying the application and the definition of payroll costs to use your 2019 numbers. And feel free to go to our website, which has all of these definitions, but also the application forms and other guidance that you can use. It's a really useful tool on the Coronavirus Act. So yes, concern about the status of the program, but it's always seemed likely they were going to expand the amount. The question now is, how long is it going to take to get that additional amount? How much will it be? And will they reduce some of that to help the states? There's just so much need out there, and it's about priorities. But as we all know, small business people, this isn't about, oh, I'll have to wait another 2 weeks. I can't wait another 2 weeks. I'm going to have to let people go if I don't have a guarantee that I have this backstop. And that's what the payroll protection program is supposed to be, a backstop for your payroll. One of the questions I was asked in my last presentation is, that's too good to be true. How could they just forgive the loans? That seems like something completely antithetical to how the system works. But remember, the concept of the loan is it's an emergency, sped up replenishment of working capital. It's meant to be fast. And it's meant, by definition, it's going to be flawed in the way it's unveiled. But in the end, the point is that they did want to get these funds out. Of course they do. If they don't have the funds out there, there's going to be more unemployment. There's going to be more people who can't pay taxes, and this will be a tailspin that could lead to more than just a recession, which is what people are talking about. So that's the payroll protection program. I spent a little bit more time on that than the prior presentations I've given, because I know people are becoming very dubious about the status of this, extraordinarily frustrated about their ability to just get into the program. I am aware of websites, ours will contain it, that have lists of banks that are providing payroll protection loans. If you don't have a banker that is doing it, or your bank has said, we're out, we have no more funds to do it, there are other banks that are out there saying that if you need help, we might be able to help you. And I know the SVO website has a list of companies, and we're going to have one soon on our website. We may even already have it on our website. So speed is of the essence. If you're interested in this program, you've got to move fast to get your application in. Okay. Who are the qualified lenders for the program? All SBA certified lenders will be given delegated authority to speedily process the PPP loans. Well, after what I just said, the word speedily is maybe not a poor choice of words. The Treasury Secretary is authorized as authority to approve new lenders to make the loans. Contact your bank or lending institution to determine their eligibility. This is what happens when you have a outline that is in not real world, but is the rules, and then what I just articulated, which is the real world. It's not fast. And you do need to be very proactive in how you go about the Paycheck Protection Program. The bank will want information. Do what they say, because the banks have an enormous amount of flexibility in terms of how they interpret these rules. The 100,000 compensation limit does not include health insurance or pension contributions. If they request a calculation of how the funds are to be used, be sure that 75% is used for payroll. As I said earlier, don't worry about the forgiveness calculations. We'll get more clarification on that later. I gave you the rough outline earlier, and it's not too late to apply. It isn't too late to apply, even though the funds are currently out, because I'm sure they're going to be replenished. That other credit, the employer credit that I discussed earlier, we talked about the sick leave credit and we talked about the family leave credit. There's an additional credit called the employee retention credit. Again, flowing through your payroll taxes. The CARES Act included a 1-year credit against the 6.2% employer portion of Social Security payroll taxes. Now it's all your federal payroll taxes for any employer forced to suspend or close operations due to COVID-19, provided the employer continues to pay employees during the shutdown. Businesses that remain open, but for which gross receipts during any quarter in 2020 were less than 50% of what they were for the same quarter in 2019, will be entitled to a credit each quarter until sales reach 80% compared to the prior year's quarter. There's a limitation on the employee retention credit. The amount of qualified wages for each employee may not exceed $10,000. Therefore, the credit is equal to 50% of qualified wages, so a maximum credit of $5,000 per employee. The credit is refundable. If it exceeds the employer's payroll tax liability, it's refunded. And remember that refunding process has been sped up because it's going to go through your payroll deposit now, as opposed to being requested through a payroll tax, Form 941 payroll tax form. And if you have a refundable amount, have a Form 7200, which is the form you will submit to get that amount refunded quickly. Important. Everybody's saying, well, wait, you've got a family leave credit. You've got an emergency sick leave credit. Now you've got this employee retention credit. You've got the payroll protection. Can we just pick and choose? Can we do them all? Any wages used to calculate the new payroll tax credit for the Expanded Family Leave Act or the Emergency Paid Sick Leave Act, which were part of the recently enacted Family First Coronavirus Relief Act, may not be considered for the employee retention credit. The employee retention credit will not be available to employers who take out a payroll protection loan. The payroll protection loan is the home run. That's the one you need to focus on because it's a forgiven loan. These other credits should be looked at carefully after you address the issue of the payroll protection loan. Update, this is what I felt I should cover earlier because it also applied to the family credit and the sick leave credit, is that the early response to the credit was the employers would have to wait to file payroll tax to get the credit. So the law was amended. All credits outlined here, all three of them, will offset not only the employer's share of Social Security taxes on a payroll tax return, but also the federal income tax withholding and the full amount of the employer's share of payroll taxes. And the employer will receive an immediate benefit equal to the anticipated credits by reducing the amount of the required payroll tax deposit by the computed credit. There's a deferral element too. Once you go through all the credits, the deferred payment of employer payroll tax and self-employment tax, the employer's share of the 6.2% Social Security tax that would otherwise be due from March 27th to December 31st, 2020 can be deferred. It may be paid 50% on December 31st, 2021, with the remaining 50% due on December 31st, 2022. That's the employer's share of the 6.2% Social Security tax can be deferred. Its deferral is not available to an employer or self-employed individual who receives a payroll protection loan that is ultimately forgiven. It makes sense. You can't get something forgiven and also get a credit for those wages. And that's just, you need to be mindful that you can't triple dip. So those are all the parts of the CARES Act that relate to loans and things that we are kind of new at as accountants. We're not small business loan experts typically. What we do spend our time on are the following items that we're going to be discussing. Tax law changes that were implemented to help coronavirus victims at businesses. And they were focusing on 4 items. These 4 items are basically law changes that were enacted in 2017 that actually hurt business. Most of the Tax Act in 2017 helped, but there were 4 provisions that did not help businesses. And one was the net operating loss provision. A little history here. In the past, years ago, as a preparer of a tax return, if that business had a loss, it was a net operating loss, and we could carry it back 2 years or carry it forward 20 years. The 2017 Tax Act amended that and said there were no longer going to be carrybacks, and the carry forward would be limited to 80% of your taxable income. The CARES Act amends this. It allows the 2018, 2019, and 2020 NOLs to be carried back up to 5 years. So if you're suffering a loss or suffered a loss in 19, and you were not able to carry it back under the old law, you are able to carry it back. Alternatively, a taxpayer may carry forward the NOL to 2019 and 2020 without that 80% limitation. Now, as an experienced preparer, or as Raj said, a seasoned preparer, we know that the carryback process can be slow because you have to file an amended return. However, if you do the carryback application within a year, you get to do it in a quicker form, 1139 is the form, and get that refund applied against prior taxes quicker. So in the last week, this is another new update. They're allowing you to use that more quick process to get that carryback applied. If it was a 2019 NOL, they're allowing you to go back further than a year to use the quicker form rather than the amended tax return approach to apply that NOL carryback. So liberalization of the NOL rules. Now, the liberalization of those NOL rules is going to be important when I explain some of these other rules that may trigger NOLs that you could carry back. QIP, Qualified Improvement Property. If you're a business, particularly a small business, over the years, if you had leasehold improvements, improvements to the interior of your property, in the old days, you would have to depreciate those costs over a long 39-year period. That took forever to depreciate a very large number for a lot of companies. So if you were a restaurant and you had $3 million of improvements, you'd have to depreciate those improvements over 39 years. So over the last 3 or 4 years, or actually longer than that, there has been efforts to liberalize this approach, to allow you to write it off quicker. So they allowed a lot of these QIP, Qualified Improvement Properties, to be depreciated over 15 years. And there were different categories: restaurant property, retail property, common improvement property. And so in the 2017 Act, they decided to simplify it even more. And they said all qualified improvement property will be allowed to depreciate over 15 years. Not only that, but because it's a life of under 20 years, 15 years, you'll be able to use bonus depreciation on those improvements. Bonus depreciation used to be 50% of the cost, but the Act liberalized that. It could be 100% of the cost. That $3 million number I just said for the improvements, you could have potentially written off the entire $3 million, an enormous boost for companies that were capital intensive. Problem, they screwed up in the 2017 Act. They forgot to change the language in the law about the life of the property. They didn't include the description of the becoming 15-year property. They kept it at 39 years. So we weren't able to use the 15-year life, a disaster. And since it was a law, the only way to fix the law, they couldn't do it through some kind of revenue procedure or something. They'd have to draft a new law. Good luck with Congress in its current argumentative state. They got creative, however, with the CARES Act. I didn't see this coming, but they reached in and said, this is a new law. We are going to pass this law with unanimous consent. And when we pass this law, we're going to fix that problem. So they retroactively fixed the problem, changed those assets back to 15-year. It's retroactive to January 1st, 2018. So taxpayers may be able to file amended returns to claim this refund. So that's a huge relief to those people. There's some other elements of this that get complex, but that's the basic foundation of the change. The allowance to write off qualified improvement property right away and to amend previously filed returns to get it written off right away. Another major change is the interest expense deduction limitation rules. That 2017 Tax Act limited business interest expense deductions to 30% of adjusted taxable income, a number calculation that we don't need to go into, but it's essentially the business income of the firm. So particularly real estate enterprises where interest deductions are a significant part of their deductions and certainly more than 30% of their income. This was a real bad development. The act, by reducing it to 30%, really forced businesses to use what was called a safe harbor. The safe harbor allowed those businesses to not adhere to that 30% rule, but they would be forced to use a much more conservative 39-year depreciation life on their assets, which was a disaster because then they couldn't use that bonus depreciation I just described. The CARES Act fixed that. It increased the limit to 50% of adjusted taxable income for 2019 and for 2020. So to help even out the business income in 2019, you're probably going to have business losses in 2020, and you may have had prolific income in 2019. So what good is it to be able to deduct 50% of your interest, of your income? If you have no income, they're going to allow you to use 50% of your 2019 number to calculate your interest deduction for 2020. This is where it relates to your NOL rules. So say you have $5 million of interest expense, and in 2019, you had $10 million of income, adjusted taxable income, just using huge round numbers. But in 2020, you did not have any income. That person would be allowed on their 2020 to deduct 50% of their interest because the limitation would be based on the 2020, so they'd be able to deduct 19, so they'd be able to deduct that $5 million. So they would have had a net operating loss. They would have increased that operating loss in 2020 by this newly allowed interest expense. And now with the liberalization of the NOL rules, you'd be able to carry it back 3 years. And then with the liberalization that happened this week about your ability to file those NOL forms, you'd be able to get it back quicker. So those are all important distinctions. The interest rules have been liberalized. You're going to be able to write off more interest. You're going to be able to create an NOL with that write-off potentially, and you're going to be able to carry back that NOL 5 years with the enforcement of the NOL provisions. Partnerships are typically not able to amend tax returns. And a lot of the entities that have these huge interest deductions are partnerships. So if you're a partnership out there and you had limitations enforced on you in 2019 because of these rules, and you weren't able to amend those 2019 returns because of some other rules, there's some liberalization here as of the last week or so. Partnerships will be eligible to amend their returns for last year to adjust for all of these things I just mentioned. And that amended return will therefore incorporate potentially larger interest deductions, larger depreciation deductions, and you'll be able to do it quicker because of the provisions that allow you to file these forms quicker. So those are all the provisions that are liberalized from a business point of view. Before I get into other questions, I just know from the top of my head that I forgot to mention on the stimulus portion, on the things that have been extended, the extension of time to pay your IRA deduction has been extended from April 15th to July 15th. Your HSA contribution date has been extended to July 15th. This is a new one. If you're involved in a tax-free exchange, you have a 45-day period to identify replacement property and a 180-day period to find replacement property in an exchange. What happens if those dates fall within that period before July 15th? They are extended to July 15th. There's some complications on the exchange area because a lot of people in that community want it to be 120 days, which is a previously written rule when there's a disaster, and we're waiting for more guidance on that, but you at least have some relief on that. Before I get to your questions, I had a couple of questions that had come in that we've discussed before. The guaranteed payment element, as I said, is now included in payroll costs. Yes, the forgiveness portion of the PPL it is true. It's just that we have to pay attention to the status of the law. And I believe I do need to leave some time for some questions, so I'll cut it off there and allow, if we've got some interaction here, for Lori or Raj to give me any questions if they're out there.
Hi, Tom. Yes.
I have plenty of other questions here, but go ahead.
Definitely. Thank you so much. We have a question from one of our participants. It says, we have been approved for an SBA loan. Are the employee portions of FICA and federal income tax withheld forgivable or not?
Okay. The answer to that is, I think that's an eligible pay. If it's I would assume that's the payroll protection loan they're talking about, but you said a small business loan. So they are part of the payroll cost as a total includes those FICA amounts. When I said earlier that we are waiting for more guidance on the forgiveness part, the question that that person just asked is one of the ones we're waiting for guidance on because we're not quite sure if it's added. My philosophy is right now, until I get further guidance, is I'm going to be aggressive and add those costs as payroll costs to be forgiven. Another question that got asked is, okay, some people are creative. They said, if the payroll during the covered period has to be maintained at 100%, can we pay bonuses if we're out of kilter? The answer is actually yes, in terms of the way the law is written. Right now, you can pay bonuses. Can you prepay rent? That is more dubious. That's a perfect example of why we need more clarification about payments that you make during this covered period. Remember, the primary intent of the law is to provide a backstop for payroll. The person's question was about payroll taxes, so I think that's one of the reasons that will be included. So I think that's what the answer is on that.
Thank you. Next question, it says, we're using a third-party payroll processor, Paychecks, and we have paid the employee EPSLA in the last period. However, they still take the full amount of money out from our bank account related to the employee's e-sick leave pay. And I asked Paychecks, how do we get back our credits? And they couldn't answer my questions. Do we have to file Form 7200 to get back our payroll tax?
Okay, so the answer is, if you are trying to get that credit back quickest, you should do it through your deposit, not through the filing of the payroll tax return. If there is an excess, that is where the 7200 form has to be filed. They're promising us that if you have a credit, that the 7200 will be processed quickly, and that's the whole purpose of the credit. But that's the form of, and that's the means by which you get the credit back.
Thank you. I think you've already answered this, but it says, can you apply for the PPP loan and still take the payroll tax credit, or do you have to choose one or the other?
No, you have to choose one or the other. Okay. And the PPL is usually the choice of preference because that's the loan, that amount is forgiven. So I always tell my clients, focus on the PPL. Those same clients that I told that to may be calling me today saying, you know, that loan you told me to focus on, the PPL, I think it's out of funds. So should I now start focusing on the payroll credits? Fluid situation. I really think they are going to reinstate more funds for the PPL. But in the end, you've got to keep your eye on all of these and maximize all of these credits with your, hopefully with the support of your accountants.
Thank you. And it says, is the language in PPE for the forgivable period talks about expenses incurred and expended? Does that mean the money has to have left the bank? There are a few employees who are paid.
There are so many questions on this. That's a super smart question because that's why I'm trying to be as specific as I can when we can, but on the forgiveness part, we're having to hedge. A similar question is payroll is accrued sometimes. Is it accrued payroll? Is it paid payroll? To that person's question, does it have to leave the account? It says funds allocated for the appropriate purposes in the law. Does allocated mean paid or does it mean accrued? I hate to be a little gray on it, but I think we're just going to need some guidance on that. But as I said, my philosophy is in the absence of guidance, be aggressive. Include those numbers if they're not clear, be aggressive and interpret it aggressively to say it is a qualified expenditure in that category. And it does qualify for payment in the covered period that allows you to get potentially some forgiveness.
Thank you. May we increase pay for employees during the period and get it forgiven? Also, if I have a 0.5 FTE leave during the forgiveness period, can I promote another existing 0.5 FTE to 1 so my FTE count is the same even though my head count is decreased?
It is, I knew there were going to be tons of questions on these. I think there is a provision. The one thing they did address is on the employee side. So remember I said that you need to retain these broad terms they use. You need to retain your employee level during the covered period, your FTEs, which is what this person's asking about. There is a provision that says, if your FTE amount went down during that period, you have the capacity to restore it before June 30th by adding somebody back. There is also provision that, so that's on that front. On the question about the payroll, whether or not it's what that person just said, I think the answer is yes, you can. It is, again, we're going to need a better clarification of just how they're going to define these expenditures that you do during the covered period as to whether or not they qualify or not. Because I gave an example, prepaid rent. That person gave an example, bonuses or increasing salary of one person to make up for another person. A bunch of my clients already asked me that question. So I'm familiar with the question. I've looked into the guidance. They talk about whole numbers in the guidance. When you do the payroll protection loan application, I don't think it's a coincidence that one of the questions they ask is how many full-time employees do you have? I think that their intent is to use that as your denominator. You need a numerator and a denominator. The numerator is going to be the amount of employees, FTEs, that you kept during the covered period. You want that to be as large as possible, which is that person's example. The denominator, you want to be as low as possible. You want that to be as few employees as possible to get the higher percentage. There is a provision that says you can use two ways to compute your average amount of employees going into the program. You can use a prior year's number, or you can use a more current approach. And I can go into that more detail if somebody wants to send me an email or anything like that, because we're getting a little into the minutia, but that's how that works. The forgiveness part of this is a lot of questions. In my world, when there are questions, that's opportunity, not a cause for concern. We just go for it when there's questions and you have some good ideas and you read the law literally, you just interpret it as literally as you can.
Thank you, Tom. And in the interest of time, we'll just take two more questions. Can you take the credit for emergency sick leave prior to the PPL taking effect? Or if you get the PPL, you can't at all?
Oh, it's a really good, I keep saying it's a good question, but it is a good question. The term they use is applied for the PPL. So that tells me no on that question. If you've applied for it, but if you haven't applied for the PPL, I think you go ahead with your normal sick leave credit approach.
Okay, great. So last question. Are there still funds in the EIDL disaster program?
Well, I think when the SBA says they're currently not accepting the PPP, I think the code language there is that they're out. But I don't know that for a fact. And the terms and the nature of the EIDL are quite different. Remember, everybody says, well, how do they determine the amount? Well, the amount on the disaster loan is a function of the paperwork you provide and the need you identify and prove. So I think the SBA they just funneled everything to the SBA to handle all this. And I think that the answer is likely that they are also not able to handle it. In point of fact, as I said earlier, the people that were trying to do both, important, you can do both. The people that are going through the SBA website to do the SBA loan were having trouble even initiating it, let alone getting it funded.
Okay, thank you, Tom, very much. And thank you, everybody, for joining today. Just a reminder, this webinar will be posted on our dedicated website, eqcovid19.com, and I'll be sending a link either Friday or Monday for you to view in your own time. Thanks again, everyone.
Thank you very much. Really appreciate you doing this, taking time out of I can't imagine how busy days you have with all those valuable clients that you have. So really indebted to you for doing this.
Thank you, Raj. Appreciate it. Check our website again for that. It's a great resource center for application forms. I went fast on some of these things on the sick leave and family leave. If you're looking for more explanations, it's clear, it's useful, and it's easy to access.
When we send this recorded webinar out on Monday, we will send a link to your website and this deck.
Wonderful. Thanks, Raj. Hope it helped.
Thank you, everyone.